Runway to record demand, the senior housing investment wave of 2026. The commercial real estate market continues evolving in 2026, but one asset class is separating itself from the pack, and that is senior housing. And this is driven by powerful demographic trends, historically low new supply, rising occupancy, improving operations, and aggressive institutional investment activity. And senior housing is rapidly becoming one of the most attractive sectors in commercial real estate. And according to the 2026 Asia Senior Housing Report, the industry may be entering a multi-year growth cycle that resembles the early expansion phases of multifamily housing, but with even more predictable long-term demand fundamentals. So for investors, for operators, for developers, for lenders, and commercial real estate professionals, this sector deserves serious attention. So why senior housing demand is accelerating? And one of the biggest forces driving the market is demographics. In 2026, the oldest baby boomers are now entering their 80s, an age range that historically drives significant demand for independent living, assisted living, memory care, skilled nursing facilities, but also active adult communities. And occupancy numbers continue improving nationwide. Overall, senior housing occupancy trades at about 89% occupancy. And independent living's closer to 91. Assisted living, about 87.9. Active adult occupancy, 91.2, with 19 consecutive quarters of occupancy growth. And industry analysts now expect occupancy to exceed the previous historical peak of 91.3%. A lot of stats, but that matters because rising occupancy directly impacts rental revenue, NOI growth, property values, and lender confidence. New supply is extremely limited and demand is surging. New development is not. That imbalance is creating one of the most favorable supply-demand dynamics in commercial real estate today. And current challenges limiting new construction include elevated construction costs, high interest rates, but labor's expensive, and there's longer development timelines with approvals, but there's also yield uncertainty. And the result is that annual inventory growth has fallen to just 0.4%. Construction pipelines are at their lowest level since 2012. And some markets are now seeing negative inventory growth. It means we're absorbing what's available. And this creates a major advantage for existing owners of stabilized senior housing assets. And in many cases, investors can acquire properties below replacement cost while benefiting from future occupancy and rent growth. Institutional investors are aggressively buying, and institutional capital has fully entered the sector. Senior housing transaction volume surged approximately 83% year over year, with total investment sales volume reaching roughly about $31.4 billion. And some major buyers now include real estate investment trusts, private equity firms, institutional investors, healthcare-focused funds, but also family offices. Some notable deals include Sonida Senior Living acquiring assets from C&L Healthcare Properties for $1.8 billion. National Health Investors acquiring 9 communities for $105 million. And high-quality assets are reportedly receiving 10 to 15 competitive offers in many markets. And that type of bidding pressure is compressing cap rates quickly. So let's talk about cap rates that are continuing to compress. As investor demand rises, pricing is becoming more aggressive across the sector. And typical cap rate ranges can range from Class A senior housing, say 5 to 6%, whereas 15 to 20-year-old assets, maybe 6.5%, 7%, and 30-year-old assets, 7 to 7.5%. And why are investors accepting lower yields? Well, because many believe that NOI growth is only the beginning. And this is one of the most important concepts in commercial real estate. Small increases in NOI can create massive increases in property value. And at a 5% cap rate, your value is a function of NOI divided by your cap rate. And what that means is a $200,000 NOI increase could roughly create about $4 million additional asset value at a 5% cap rate. Slightly less at a higher cap rate as well, but multiplier effect. And this is why operational efficiency matters so much in senior housing. So debt markets are also opening back up, and lenders are becoming increasingly aggressive in the sector, again, due to improving fundamentals. And active capital providers now include regional banks and institutional lenders, but also life insurance companies. And Fannie Mae and Freddie Mac might, in certain cases, look at them. Freddie Mac alone reportedly closed approximately $3 billion in senior housing loans in 2025 and expects to increase volume to roughly $4 billion in 2026. And borrowers are also seeing more favorable terms. And that usually comes up in lower loan spreads, longer interest-only periods, or improved covenant flexibility, and increased lender competition. And for investors, that means stronger leverage options and improved acquisition economics. So let's talk about NOI growth. The opportunities remain strong with that. And operators are benefiting from multiple positive trends simultaneously. Higher occupancy, rent growth, better pricing strategies, and improved operational efficiency. And National Health Investors recently reported approximately 7.6 same-store NOI growth. And some recently acquired portfolios are projected to generate high single-digit or even low double-digit NOI growth moving forward. And a lot of that's done by improving operational efficiencies. And that's why we're attracting major institutional attention. Now, risks still exist. Despite strong fundamentals, senior housing is not risk-free. And the key operational challenges that remain are labor shortages. So staffing shortages and wage inflation continue pressuring margins. And residents are staying for shorter periods. Residents are entering facilities later in life with higher acuity needs. But also technology requirements. Future facilities will likely require additional investments into smart building systems, into AI-driven leasing and sales platforms, but also healthcare integration technology and resident connectivity infrastructure. And the operators who adapt best operationally will be the ones that are likely to outperform over the next decade. So the investment takeaway summary. Senior housing is transitioning from a niche investment category into a mainstream institutional asset class. And the long-term thesis is becoming increasingly difficult to ignore. Aging demographics, strong occupancy growth, and historically low supply, coupled with rising rents and expanding NOI margins and deep lender liquidity, with growing institutional demand as an exit option. So for commercial real estate investors, this may become one of the defining real estate themes of the next decade. We have a huge wave of baby boomers coming still. And the biggest winners will likely be investors who can identify strong operators, undermanaged assets, below replacement cost acquisitions, and markets with growing senior populations, but also areas with limited future development pipelines. Bottom line is senior housing may be entering one of the strongest long-term growth cycles in commercial real estate today. And that, my friends, is it for the day. Please visit my website, HoustonRealEstateBrokerage.com. I'd love to have a conversation with you, and you can schedule one there. Have a good day.